In parallel, Rachel and Stein should prepare a confidential information memorandum, the CIM, also known as the investor deck, to be used to attract the attention of the angel investors. There are many websites which show how to achieve a fresh look and feel for the CIM, and Rachel and Stein should learn from the mistakes of others. Freely available online with a few clicks of a mouse are the early investor decks for unicorns such as Airbnb and Uber, and there are plenty of current templates for them to use. Rachel and Stein should consider whether to seek a confidentiality agreement, or NDA, from each prospective angel investor before the CIM is disclosed. Many angel investors will not sign up to an NDA. So Rachel and Stein might defer insisting upon an NDA until such time as the angel investor asks to validate their technology. Assuming that RSK is raising less than €8 million in any 12-month period, there will be no need to prepare a prospectus. This is good news, as a prospectus is a lengthy document which needs to be prepared by specialists and requires the approval of the FCA. But there is a general prohibition preventing a UK company from offering shares directly to the public, and this will apply to RSK Limited. The relevant regulatory regime is contained in the Financial Services and Markets Act 2000. It is far-reaching and captures all forms of promotion, i.e. email, snail mail, a phone call, a chance conversation, or a formal meeting. There are a number of exceptions contained in the Financial Promotion Order 2005, meaning that Rachel and Stein will be able to send their CIM to exempt classes of investors, which include sophisticated investors and high net worth individuals.
For those of you not aware, the EIS scheme is a generous UK tax relief on early stage risk capital investments. The scheme entitles an investor to 30% tax relief on their investment, together with an exempt capital gain should they sell at a profit more than 3 years later. Should the investment be sold at a loss, an investor can utilise that loss against income taxes rather than it being a capital gain, and if relevant at the time of their investment, they can defer any other capital gains they've made in that period into their initial investment. For very early stage businesses, there's also the Seed Enterprise Investment Scheme, which gives 50% income tax relief. However, for the Seed Investment Scheme, it has to be a business that is less than 2 years old, which may not be the case here. So I'd like to take this to concentrate on EIS. In addition, the SEIS scheme is only available for £150,000 of investment, and we would expect in this case study that they would be looking for more than this. To be eligible for an EIS investment, a company must use the funds raised from the qualifying investors for the growth and development of that business. So they wouldn't be able to use EIS funds to buy intellectual property or the going concern from the Netherlands company and bring it over here. In addition, the investor's capital must be at risk, i.e. that they can lose more than they would get in order to stop EIS investments being used for guaranteed return investments here. I can see from the case study that the company is looking to spend money on machinery, and we would expect that the risk to capital condition should be met, provided that machinery doesn't have a significant resale value in the next 3 years.
Assume that in 5 years' time, this mulch business really has been very profitable, with investors, being standing in line to participate and making loads of money. Then you can imagine that the Netherlands Tax Administration is going to look carefully at the arrangements that have taken place between the BV and the UK sister company, and especially the terms, the financial terms. If there has been, I think the main criterion here is that the transactions need always to be under the arm's length, on the observance of the arm's length principle. That's rather difficult when it comes to intangibles, how to value these type of situation. Different, for example, with the machinery, with the fixed asset that Roy was mentioning when it's moving out to the UK. But So the fundamental question is, is there going to be any upfront taxation in the Netherlands when this mulch business is being moved to the UK? If it's a sale, then of course it's going to be upfront taxation. Discussion on then what is the amount of the goodwill, but the sale is not possible from a UK perspective. Then if it's going to be a royalty that's granted, then we will have the profits ending up in the Netherlands, fully taxable in the Netherlands at 25% corporate income tax, which I don't think is that attractive as well. So there is really, I would say, an important question to be answered there, as to how do we make sure that this mulch business gets into this UK sister company without too much Dutch tax exposure.